topic explains the principles of capital investment decisions and the measures used to evaluate investment projects. Capital investments involve allocating significant financial resources to long-term projects such as expanding production facilities, purchasing equipment, launching new products, or entering new markets. Because these decisions affect future profitability, competitiveness, and corporate value, firms must evaluate projects carefully using financial analysis techniques. The topic emphasizes that effective capital allocation is essential for maximizing shareholder wealth and ensuring sustainable growth. Analysts and managers assess expected cash flows, project risk, financing costs, and strategic implications when determining whether investment opportunities should be accepted or rejected. The capital budgeting process begins with identifying potential investment opportunities and estimating their expected future cash flows. These cash flows typically include initial capital expenditures, operating cash inflows, ongoing expenses, tax effects, and terminal values at project completion. Because investment projects often extend over many years, firms must account for the time value of money when evaluating future benefits and costs. Accurate forecasting is critical because errors in estimating revenues, costs, or economic conditions can significantly affect project profitability. Analysts therefore examine assumptions carefully and often perform sensitivity analysis to evaluate how changes in variables such as sales growth or operating costs influence investment outcomes. Net present value, NPV, is one of the most important project evaluation techniques discussed in the topic. NPV measures the difference between the present value of expected future cash inflows and the present value of project costs. Cash flows are discounted using the firm's required rate of return or weighted average cost of capital to reflect project risk and opportunity cost. A positive NPV indicates that a project is expected to create shareholder value because projected returns exceed the required return. Projects with negative NPVs should generally be rejected because they reduce firm value. NPV is widely regarded as the most reliable capital budgeting method because it directly measures value creation. The internal rate of return, IRR, is another commonly used project evaluation measure. IRR represents the discount rate that makes a project's NPV equal to zero. Firms typically compare the IRR to the required rate of return when deciding whether to undertake a project. If the IRR exceeds the required return, the project is generally considered acceptable because expected returns compensate investors adequately for risk. While IRR is intuitive and widely used, it has limitations. Projects with unconventional cash flow patterns may produce multiple IRRs, and IRR comparisons can sometimes give misleading results when projects differ significantly in size or timing of cash flows. Analysts therefore often prioritize NPV when conflicts arise. The topic also introduces additional project evaluation measures, including the payback period and profitability index. The payback period measures how long it takes for a project's cumulative cash inflows to recover the initial investment. Firms may prefer shorter payback periods because they reduce uncertainty and improve liquidity. However, the payback method ignores the time value of money and cash flows occurring after the payback period, limiting its usefulness for long-term value assessment. The profitability index measures the present value of future cash inflows relative to initial investment cost. Ratios above 1 generally indicate value-creating projects. These supplementary measures help firms compare investment opportunities under varying financial and operational constraints. Overall, topic highlights the importance of disciplined capital investment analysis in corporate financial management. Investment projects require significant long-term commitments of financial resources and therefore must be evaluated carefully using techniques such as NPV, IRR, payback period, and profitability index analysis. Effective capital budgeting improves shareholder value by allocating resources to projects expected to generate returns exceeding their cost of capital. At the same time, poor investment decisions can weaken profitability, increase financial risk, and reduce competitive advantage. For CFA candidates, understanding project evaluation methods is essential because capital allocation decisions significantly influence corporate growth, valuation, financial performance, and long-term investment attractiveness.